QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currency will weaken maturity transactions within QuickBooks for accounts payable. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our problem 3, multiple currencies practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. Let's see where we stand at this point by going to the balance sheet, going to the reports dropdown, company and financial balance sheet standard, otherwise known as the standard balance sheet. We want to then customize the reports to change the dates from 01/01/21 to 12/31/21, and then we're going to say OK. So we put our forward contract on the book. The receivable side of it will be in dollars, so we're not too much activity happening there. Where all the action is down here on the payable side of things. It's going to be paid in pesos, 5,000 pesos to be exact, in the future, and then we'd have to value them on our statement with the exchange rates that would be appropriate for the dates necessary. So when we put it on the books, we used the forward rate as of 10/1 when we started this process. We then adjusted it at 12/31 to make it to the correct amount as of that point in time for the presentation of the financial statements. Closing this back out, I'm going to update the date to 2022. We then transferred some money from the U.S. Checking account, or the checking account in dollars, to pesos so that we can then pay off the payable. Now, the payable and the amount of money we have don't tie out right now, because if we look at our Excel file over here, we did an adjusting entry for the $50 to account for the current spot rate. We're not going to do that within QuickBooks because we want that to be done basically by the system. So in other words, when we go into QuickBooks, what's going to happen? I'm going to go to the home page here. We typically have the bill that we enter to put the payable on the books, then the pay bill. Now, if we didn't have any crossover in terms of needing an adjusting entry at the end of the period, QuickBooks would basically record the transaction, the adjustment between these two time periods and the related exchange rates, recording a decrease to the payable when we pay the bill, decrease to the account for the cash account, and then the change, gain or loss, on the income statement. It will still do that now. However, at this point in time, that change needs to be broken out between the 2 years, the first year and the second year. So we're going to do that by doing an adjusting entry and then a reversing entry. We won't do the reversing entry yet because I want to show how it will be doubled up, and then we'll do an adjusting entry next time to kind of fix the doubling up process. So this will all pan out as we go through and make sense, hopefully, as we do so. So now we need to enter the pay bills. Now, before we were to pay the bills, we want to make sure that the exchange rate is correct. So I'm going to go to the lists drop down. I want to take a look at the currency lists. And then if we were doing this as of today, we can go to the activities rise up and download the latest exchange rates here. Because this is a practice problem, I'm going to double check the exchange rate is correct as of the date that this transaction will take place. Double clicking on the peso 4.1, that's what we want, 4.122. We already input that at 0.77. So that's going to be the current exchange rate. The prior exchange rate is 0.74 when this whole thing started. The 0.78 is the cutoff date. So the payable is going to be looking at the 0.74 comparing to the 0.77 when we pay the bill and doing the gain or loss adjustment according to those two numbers. Let's check it out. Closing this out, we're then going to go to the home tab. We're going to go to the pay bill. Let's pay the bill. Bill wants to be paid. So we're going to say this is going to be the payable for the MXN. So the peso here, this is the one we want, of course, checking it off, changing the date. The date looks correct. The rate then 0.77. That then looks correct as well. So we want to take this out, not of the US account or the cash account, but out of the peso account here. So that looks good. And then I'm going to assign the check number. So this means that we're actually going to be paying 5,000 pesos out of the checking account with the 5,000 pesos in it, which will convert to the 3,850 in terms of dollars, US dollar equivalents, according to the current rate, which is the spot rate, the actual exchange rate at this point in time, the 0.77, and the difference then is going to be recorded to a gain or loss. So we're talking about the difference between, again, the first date that we put it on the books for and this date when we're terminating it, not taking into consideration that period in, or the adjusting date in the middle. So let's see what that will look like. We're going to pay the bill and then check it out. So pay selected bills. And then I'm going to just call it E1, saying it's electronic payment, we'll say. And then say OK and yes. So it has been done. Let's go ahead and check it out now by going to the balance sheet. Balance sheet in 2022. We have now paid off the payable, but there's still $200 in it. Why? It should be 0. Why? Well, if I double click on it, then change the date so we can see the detail from 01/01/21. And so there's the detail. So we put it on the books at the 3007 using the spot rate at that time. Then we had that $200 adjusting entry. And what QuickBooks basically did is it took it off the books, at the original amount, and then recorded the gain or loss. So it took it off the books at the original amount, recorded the decrease to the checking account, and then recorded the difference, the full gain or loss, on the income statement. So we doubled up on the $200 portion because we needed to record that into the prior year. So we're going to have to get rid of that $200. That would be done with a reversing entry that we're going to do as of January 1st, 2022. So we'll do that next time, but let's just consider this. I'm going to close this back out. The other side then, of course, closed out the checking account, which we can't see for the Mexican pesos here because it's 0 now. Let's go ahead and look at the trial balance, which will help us to see it by going to the reports drop-down, or accounting and taxes, trial balance, the trusty TB, going from 01/01/22 to 12/31/22. And there we have our pesos checking account is now down to 0. So it has gone down to 0. That represents the 5,000 pesos that we actually had that we paid out, valued at the current spot rate or exchange rate, 3,850. Closing this back out then, the other side is on the income statement. Let's look at it on the income statement. It's here too, but want to see it on the income statement. So we'll go to the reports and company financial profit and loss, P&L income statement, changing the dates from 01/01, let's go 22 to 12/31/22. And there's that 150. Now note that 150, if I double click on this, it's being recorded from the bill, the pay bill. If I go and look at Excel now, what happened on Excel, you see that we broke out between the 2 years. If I was to add them together, it nets out to 150 over the 2-year time period. But we need to be allocating 200 to year 1 as a loss and 50 to year 2 as a gain, because that's how it basically worked out, or split out the way the exchange worked. This recorded the full amount at the time we paid the bill. In other words, if I go back to the home page, if there wasn't a cutoff period, if I didn't need this middle adjusting entry, I wouldn't have to do any adjustment in order to pay the bill, because when I pay the bill, it does that basically for us, meaning it takes the difference between the rate at the point in time we entered the bill and the time we paid the bill and records the full change at that point. Because we had this adjusting entry, it's throwing us off there, and we have to then fix that. We'll fix it by doing an adjusting entry, then reversing entry to allocate the correct amount of that 150 to the first and second year. So in other words, if I go back to the profit and loss here, there's the 150. If I double click on that and take a look at it for the first year and see the crossover, we have the journal entry that we put in there at the beginning, the 200, and that was to record the portion for the first year, and then the 150. So what will happen is the 200 is correct as of the end of year 1. We'll reverse it in the first period of year 2, and it'll net out against the 150, leaving the $50, which is correct. That will be the correct breakout between year 1 and 2. So that's going to be a standard kind of reversing entry type of process. Could be a little bit weird to get used to at first, but it's a standard kind of process here. So we enter the adjusting entry in. We're going to reverse it as of January 1st of 2022. And you might say, why don't I put it in there as of 4/1? And the reason is because we want all of our reversing entries in there as of the same day, and we're okay with it being wrong, basically, for this time period, because we want it to be correct periodically, in this case, at the end of the year. So we'll make the adjustments periodically, either end of the month or the end of the year. We're basically thinking year end at this point in time. So it will be right once we enter the bill at 4/1. It'll be wrong after we do the reversing entry, because it'll have the 200 there that's not quite right in the current period up until we actually have this bill payment, and then it'll be right on a periodic basis. It will then be right as of the end of the cutoff date which is what we want because that's when we make the financial statements, in this case, at the end of the year. So we'll take a look at the reversing entry to settle that out next time.